Friends, thank you for being here today. There is a story unfolding in the global financial markets, a silent but seismic event that most people are failing to see. It is a narrative obscured by the daily noise of inflation reports, interest rate predictions, and fleeting market sentiment. What if I told you that the financial headlines you read every day are not just missing the story, but are in fact a form of misdirection? And what if the real story is a quiet tectonic shift in global power that has already begun? A story told not in newspapers, but in the silent accumulation of physical gold by the world's largest nations. The mainstream media, whether by deliberate omission or a fundamental misunderstanding of the forces at play, is missing this. Today, we pull back the curtain on this untold narrative to reveal the genuine underlying reason that gold, the ancient and stoic metal, is defying all modern expectations and carving out new, unprecedented records. What is truly happening behind the scenes is a story of power, trust, and a fundamental reshaping of the global order. Most people believe they have a firm grasp on the role of gold. They see it as a relic, a shiny rock pulled from the earth that serves as a kind of financial insurance policy. In this common view, gold is a simple safe haven, an asset that investors instinctively run to whenever the global economic or political landscape looks shaky. When stocks tumble, when geopolitical tensions flare, or when inflation begins to erode the value of savings, the flight to gold is a predictable, almost reflexive reaction. And while there is an undeniable element of truth to this, it represents only a surface level understanding. It explains the ripples, but not the deep, powerful current that is driving gold's value at this very moment. What is happening now is something far more profound, something of monumental importance, and something to which almost no one is paying adequate attention. To truly comprehend the significance of this moment, one must first appreciate the paradox at its heart. Let us slow down and think critically. Why is gold, of all assets, setting new all-time highs at a time when many of the world's most seasoned experts insist that its value should be in decline? If you adhere strictly to the logic of economic textbooks, if you listen to the consensus of financial analysts, you would naturally expect the opposite trend to be in effect. For the better part of the last 2 years, the United States Federal Reserve, the most powerful central bank in the world, has been engaged in an aggressive campaign of monetary tightening. It has been raising interest rates at a pace not seen in decades, systematically shrinking its colossal balance sheet and deploying every tool at its disposal in a declared war against inflation. By every conventional measure, this environment should be toxic for gold. Gold, after all, pays no dividend and yields no interest. In a world of rising interest rates, government bonds and even simple savings accounts become more attractive, offering a risk-free return that gold cannot match. This increasing opportunity cost of holding a non-yielding asset should, according to theory, dampen demand and push its price downward. The logic is straightforward. Why hold a bar of metal that produces nothing when you can hold a government bond that pays you 5% annually? And yet, in the face of this powerful headwind, gold is not just holding steady, it is exploding. It is not falling. It is soaring to heights that would have been unimaginable just a few years ago. This is the central mystery we must uncover. Why is this ancient monetary metal behaving in a way that seems to defy all modern financial logic? What immense unseen force is powerful enough to overwhelm the gravitational pull of rising interest rates and a stronger dollar? The answer, as we will explore, has little to do with the short-term market noise that captivates the media. It is a story not of fleeting fear, but of a permanent structural shift in the architecture of global finance. Once you grasp the sheer scale of this bigger picture, you will never look at a bar of gold or the dollar against which it is measured in the same way again. To begin our investigation, we must start with a simple but crucial observation about the fundamental nature of gold itself. Gold is not a company. It does not innovate, it does not produce, and it does not generate earnings. It will never invent the next iPhone, deliver a package overnight, or release a blockbuster streaming service. Gold, quite simply, just sits there. It remains unchanged, inert, and constant, just as it has for thousands of years of human history. If you were to take a pure bar of gold from the treasury of ancient Rome and hand it to an individual today, it would be precisely the same object, the same weight, the same purity, the same elemental substance. It offers no interest, it pays no dividends, and it promises no growth. It is, in its essence, just gold. It is this perceived lack of utility that leads many modern investors, particularly those captivated by the promise of technological disruption and rapid growth, to dismiss it. They label it as boring, unproductive, a dead asset that merely occupies space in a vault. And yet, this perspective misses the entire point of gold's enduring value. Despite producing nothing, it has silently and effectively preserved wealth across the rise and fall of every empire, through every currency collapse, and during every devastating inflationary spiral recorded in human history. This is not an accident of history, it is a direct consequence of its immutable nature. To understand why gold is skyrocketing now, you must compare it not to a technology stock or a real estate investment, but to the only thing it has been truly measured against for the last century: paper money, and specifically the United States dollar. Let us look back in time to a pivotal moment in monetary history, the year 1971. It was in that year that the United States officially and unilaterally severed the final link between the dollar and gold, ending the Bretton Woods system that had governed international finance since the end of the Second War. On that day, an ounce of gold was officially priced at about $35. Imagine that for a moment, $35. Today, we are not speaking of hundreds, but thousands of dollars to acquire that very same ounce. What changed so dramatically in the intervening decades? It was not the gold. The gold did not multiply in the vaults. It did not become more useful, and it did not evolve into something new. The gold is the constant in this equation. What changed profoundly and irrevocably was the dollar. Paper money, or fiat currency as it is known, is fundamentally different from gold in one critical respect. It can be created from nothing at will by the government or central bank that issues it. And in moments of profound economic or social crisis, and the temptation for governments to print more of it, to create currency out of thin air in the hope of papering over structural problems and keeping the system afloat, has proven to be irresistible throughout history. This singular characteristic is both the greatest strength and the most fatal flaw of every fiat currency ever created. It provides flexibility in a crisis, but it also guarantees an inevitable and permanent loss of purchasing power over time. The history of the last 50 years is a clear and undeniable testament to this truth. The dollar has not held its value. It has been systematically devalued, and the rising price of gold is simply the clearest available measure of that long-term erosion. The gradual erosion of the dollar's value transformed into a full-blown collapse of trust in the wake of two defining crises of the 21st century. The first of these events was the global financial crisis of 2008. Before that cataclysmic point, the Federal Reserve's balance sheet, a measure of the assets it holds and, by extension, the amount of money it has created, had been remarkably steady for years, hovering around a figure of roughly $800 billion. It was a large number, to be sure, but one that grew in a slow and predictable manner, reflecting the steady growth of the economy. Then the crisis hit. The collapse of the subprime mortgage market triggered a cascade of failures throughout the global banking system, pushing the world to the brink of a second Great Depression. In response, the Federal Reserve and other central banks unleashed monetary interventions on a scale that had never before been witnessed in human history. Almost overnight, the Fed's balance sheet did not just grow, it tripled in size. The central bank printed staggering sums of money to bail out failing banks, to purchase toxic assets, and to inject liquidity into frozen credit markets. In doing so, something irreversible happened. The unspoken pact of fiscal prudence was broken. A clear signal was sent to the world that when faced with a choice between systemic collapse and limitless money creation, the authorities would always choose the latter. Trust in the long-term permanence and stability of the dollar began to visibly erode. And right alongside that erosion, the price of gold began to soar, breaking through $1,000 per ounce for the first time and signaling the beginning of a new era. Fast forward to the year 2020, a new crisis emerged, this time a global pandemic that brought the world's economy to a standstill. Once again, faced with an unprecedented economic shutdown, the Federal Reserve had no choice but to deploy the same strategy it had in 2008, but this time on an even grander and more breathtaking scale. The previous interventions, once considered shocking emergency measures, now looked quaint by comparison. The Fed's balance sheet did not just grow, it exploded, surging to a peak of nearly $9 trillion. The supply of United States dollars in the global system did not just increase, it went vertical. Trillions were created to fund government stimulus programs, to backstop corporate debt markets, and to ensure the financial system did not seize up. And just as before, gold's price responded in lockstep. It surged to new record highs, not because gold itself was creating any new intrinsic value, but because the very yardstick we use to measure it, the dollar, was being stretched thinner and thinner, debased on a scale that was previously unimaginable. Each new dollar created devalued every other dollar already in existence, a simple and inescapable law of supply and demand. This brings us back to our central paradox. The Federal Reserve has, for the past couple of years, been trying to put the genie back in the bottle. They have been attempting to undo some of this unprecedented monetary expansion, shrinking their balance sheet and raising interest rates. By all traditional logic, this monetary tightening should be causing gold to tumble, but it is not. It is only going higher. This is the real mystery, the one that the headlines about inflation and interest rates cannot explain. What is this powerful, counterintuitive force that is driving gold upward when all the conventional signals point the other way? Here is the secret. The media will not tell you the deeper current that is reshaping the world beneath the surface. The historic rise in the price of gold is not just about inflation, and it is not just about the Federal Reserve's latest policy decision. It is about something much bigger, much more structural, and with far more profound long-term implications. A global shift in power and the accelerating rise of nations that no longer place their trust in the United States dollar. For decades, following the end of the Second World War, the dollar has reigned supreme. It has served as the world's undisputed reserve currency, the one asset that every country, every corporation, and every major financial institution had to hold to participate in global trade and finance. Nations across the globe stored their national wealth in United States Treasury bonds, believing it to be the safest, most liquid, and most reliable place to park their money. This system, often referred to as the petrodollar system, granted the United States what one French politician famously called an exorbitant privilege. It could print the world's money, allowing it to run massive trade and budget deficits without facing the immediate consequences that any other nation would suffer. But over the last 20 years, the trust that underpins this entire system has been steadily and systematically eroding. And in the last few years, that erosion has accelerated into a landslide. The primary catalyst was the realization by other world powers that the dollar based financial system could be and would be used as a weapon to enforce American foreign policy objectives. The decision to freeze the foreign currency reserves of Russia held in Western banks following the conflict in Ukraine was a watershed moment. It sent a shockwave through every capital city from Beijing to New Delhi to Sao Paulo. The message was clear and unambiguous. If you fall out of favor with Washington, your nation's sovereign wealth, the accumulated savings of your people, could be confiscated at the push of a button. Consider the actions of China, once one of the largest foreign holders of United States Treasury bonds. China has been systematically selling them off in massive amounts, month after month, for years. In their place, they are buying gold. They're not just buying a little, they are buying hundreds of billions of dollars worth, accumulating the physical metal at a staggering pace. Why? Because gold is the one monetary asset that exists outside of any single nation's control. It is the one thing that cannot be frozen by a sanction, cannot be devalued by a printing press in another country, and cannot be seized electronically. It is financial sovereignty in its purest form. Look at Russia. After the unprecedented sanctions effectively cut it out of the dollar based global banking system, it had no choice but to double down on its strategy of gold accumulation. The Russian central bank is now one of the largest sovereign holders of gold in the world. Again, the reasoning is one of stark necessity. Gold does not depend on Washington's permission to be used as money. It is a bearer asset that is final settlement, beholden to no political agenda. Even a country like India, which for decades held only modest amounts of gold in its official reserves, has been quietly and consistently stacking it in record amounts. Their reserves are growing rapidly as their economy expands because their leaders see what is coming. They understand with perfect clarity that the unipolar dollar-dominated global system is fractured and is giving way to a multipolar world with new centers of power. These countries, along with many others in the developing world, are actively preparing for a world where the dollar is no longer the unquestioned king. They are building alternative payment systems, forging new trade alliances, and most critically, they are diversifying their national savings away from the liabilities of a competitor nation and into a neutral, timeless asset that no single government can debase or control. That asset is gold. This movement is far broader and more coordinated than most Western observers realize. It's not just a handful of nations acting independently, it is the visible manifestation of a growing coalition of countries determined to build a parallel financial architecture, one that is not subject to the whims and political objectives of a single nation. This coalition is most visibly represented by the BRICS bloc: Brazil, Russia, India, China, and South Africa, which has recently undergone a major expansion to include nations like Saudi Arabia, the UAE, Iran, and Egypt. This is no longer a fringe group. It represents a significant portion of the world's population, economic output, and most critically, its energy production. For years, these nations have been methodically laying the groundwork for what is termed de-dollarization. This doesn't mean the dollar will vanish overnight. Rather, it means creating a viable alternative for international trade and finance. They are establishing bilateral trade agreements to conduct business in their own local currencies, bypassing the dollar entirely. They are developing and integrating their own financial messaging systems like China's SIPs and Russia's SPFS, as alternatives to the Western controlled SWIFT network. Every one of these moves is a brick in the foundation of a new multipolar financial world. But what sits at the very base of this new foundation? What is the ultimate trusted asset that can settle accounts between nations that may not fully trust each other's currencies? That asset is gold. When Russia wants to sell oil to China and they choose not to use the dollar, they can settle the trade in yuan or rubles. But at the end of the day, the ultimate reserve asset that both nations recognize as final apolitical money is physical gold. It is the bedrock of trust in an increasingly trustless world. The relentless accumulation of gold by these central banks is not just a diversification strategy. It is the deliberate re-monetization of gold as a core tier one asset in a new international system. They are not just buying a commodity, they are stockpiling the reserve asset of the future. This strategic pivot represents a direct challenge to the exorbitant privilege the United States has enjoyed for over half a century. These rising powers are no longer content to have their economic destinies dictated by the monetary policy of the Federal Reserve or the foreign policy of the State Department. They are tired of their own domestic savings being used to finance American deficits. By trading amongst themselves in their own currencies and holding their surplus wealth in gold, they are actively opting out of that system. This is a slow motion tectonic process, and while it doesn't make for exciting daily headlines, its long term consequences are monumental. The demand for gold we are seeing is not speculative froth. It is the foundational demand from the world's emerging superpowers building the financial system of tomorrow. This is the real fundamental reason that gold is skyrocketing. It is not because of short term fear in the markets, and it is not a temporary reaction to worrisome inflation headlines. It is because, behind the scenes, the largest and fastest growing economies on earth are in the midst of a historic and strategic shift of their reserves out of paper promises and into physical metal. This is not speculation. It is a verifiable fact, visible in the official data reported by central banks around the world. The pace of official sector gold buying over the last 2 years has been higher than at any other time in recorded history. And this trend is not confined to governments and central banks. The very same logic is now cascading down to wealthy individuals, to family offices, to large investment funds, and even to ordinary savers around the world who are paying attention. They see the same warning signs. They see sovereign debts piling up in the United States and other Western nations to levels that can mathematically never be repaid in today's currency. The United States national debt has now exploded past $34 trillion with no end in sight. They see budget deficits growing year after year, regardless of which political party is in power, creating a permanent dependency on more debt and more money creation. They see trillions of dollars, yen, and euros being created out of thin air to patch the ever widening holes in a system that is fundamentally insolvent. And they are asking themselves a simple, rational question. Do I really want all of my life's savings, the fruits of my labor, tied exclusively to this system? Do I want my financial future to be entirely dependent on the promises of politicians and central bankers who have consistently demonstrated a willingness to sacrifice the value of their currency to avoid making difficult political and economic choices? For a growing number of people around the world, the answer is a resounding no. That is why demand for physical gold in the form of coins and bars is rising, even when the textbook logic says it should be falling. The dynamic has changed. The game is no longer about chasing yield or speculating on the Federal Reserve's next move. It has become a global, coordinated search for a financial anchor in a sea of instability, a desperate search for something solid, something real to cling to. Think of it like this. Imagine you are a passenger on a great ocean liner. For decades, that ship has been seen as the strongest, steadiest, and most reliable vessel in the world, virtually unsinkable. Everyone trusted it implicitly. But then, small cracks begin to appear in the hull. At first, they are easy to ignore, dismissed as cosmetic. Then, bigger cracks appear. The crew works frantically to patch them up, reassuring the passengers that everything is under control. But deep down, you can feel a subtle shift in the ship's stability. You can hear the groaning of a structure under immense strain, with a dawning sense of certainty that the vessel's structural integrity is weakening. What do? You do not wait for the captain to announce that the ship is sinking. You quietly make your way to a lifeboat just in case. In this analogy, the ship is the dollar-centric global financial system. Gold is that lifeboat. Let us put some hard numbers to this long-term trend. Over the last 25 years, a relatively short span in monetary history, the price of gold has climbed from around $279 an ounce to recent highs of more than $2,300. That is a gain of well over 700%. By contrast, the purchasing power of the dollar has collapsed. The United States national debt over that same period has exploded from under $6 trillion to over $34 trillion, with projections showing it continuing to grow at an exponential rate. Does anyone in any serious intellectual capacity really believe that this can go on forever without severe and painful consequences? When a government, any government, owes more money than it can ever realistically hope to repay through taxation, there are historically only two possible outcomes. It can either default on its debt outright, creating a catastrophic financial crisis, or it can inflate the debt away by printing more money. History shows us, with no exceptions, that governments always choose the second path. They will always choose to devalue the currency. They will always print. This means that, barring a complete and radical reversal of fiscal and monetary policy that is currently politically unimaginable, the United States dollar will continue to weaken in real terms, and gold will, by necessity, continue to strengthen when measured in those depreciating dollars. Now, does this mean that gold will go to $10,000 an ounce overnight? Probably not. Markets move in waves, with periods of rapid ascent followed by consolidation and correction. But does it mean that the fundamental multi-decade upward trend is locked in for the foreseeable future? Absolutely, because this story is no longer about gold becoming something new or more valuable. It is about the dollar and all fiat currencies tethered to it becoming something demonstrably less. And here is the part of this story that should keep you awake at night. The rise of gold is telling us something critically important about the world we are living in. It is not just a chart going up on a screen. It is a signal, a warning, a sign that the very trust that holds our complex financial system together is breaking down. When sovereign nations, central banks, and informed individuals all start racing to accumulate the very same timeless, non-government asset, their motivation is not simply greed. It is about survival. It is a defensive move against a coming monetary reset, the precise form of which remains unknown, but the general direction of which is becoming clearer by the day. So, the next time you see gold's price flashing across your screen, do not just think of it as an investment to be traded. Think of it as a thermometer accurately and impartially measuring the fever of the global financial system. And right now, that fever is rising fast. The media will not tell you this. They will continue to point to lagging indicators like interest rates, to noisy monthly inflation numbers, and to temporary tactical moves in the bond market. But those are just the surface ripples. The deeper current The one that is pulling everything forward with an inexorable force is this global migration out of paper assets and into the timeless safety of gold. That is the real undeniable reason that gold is skyrocketing. And once you fully understand this, you realize that this is not about what happens this week or next month or even next year. This is about the next decade and the next generation. So let me ask you a final question. If the world's largest and most powerful economies, nations that represent the future of global growth, are actively preparing for a post-dollar future by hoarding physical gold, should you not at least consider why they are doing so? Shouldn't you ask yourself what they see that you might be missing? Because in the grand sweep of monetary history, by the time the answer becomes obvious to everyone, it may already be too late.